All right, welcome to This Explainer. Today we are taking a seriously fascinating look under the hood of institutional quantitative trading. Think of it like this. We're going to take a raw algorithmic trading strategy and treat it like a fresh recruit entering the ultimate brutal mathematical obstacle course. We're exploring the Apex Execution's validation stack. It's essentially 6 intense layers of statistical evaluation that an algorithm absolutely has to survive before it's allowed to touch a single dollar of live capital.
Before any money is deployed, we have to ask this foundational question. Is the strategy actually skilled, or is it just incredibly lucky? You know, in the algo trading world, it is shockingly easy to build a model that looks like an absolute money-printing machine when you run it on past data. But we need to separate genuine, robust market edge from pure, unadulterated luck. And let me tell you, your standard run-of-the-mill backtest just isn't going to cut it here. So here's our roadmap for the gauntlet. First, the illusion of luck. Then beating the backtest trap, surviving random market paths, real-world regime testing, and finally, the final alpha gate. Let's jump right in.
Section 1. The illusion of luck. This is where we hit layers 1 and 2 of the Apex stack, and honestly, this is where amateur illusions of success just vanish.
0%. That is exactly how much survivorship bias is allowed through the doors at Apex. None. Every single strategy is judged on its actual merit, not cherry-picked data where only the lottery winners are remembered and all the losers are conveniently swept under the rug.
This brings us to the industry's biggest trap. Standard Sharpe ratios lie to you. They literally inflate with every single parameter trial run during research. If you tweak your strategy 100 times, well, your Sharpe ratio is going to look amazing just by pure chance. That's exactly why Apex uses a mathematically corrected, deflated Sharpe ratio. It's statistically honest. It adjusts for the number of trials, for skewness, lopsided returns, and kurtosis, which is basically the risk of wild extreme market swings.
Right out of the gate, our candidate has to hit these conservative metrics. We're talking a deflated Sharpe ratio of at least 0.60 and a probability of backtest overfit bounded tightly below 30%. This mathematically proves the results aren't just a lucky artifact of an exhaustive parameter search. If it can't clear this, the algorithm is rejected instantly, no second chances. Moving on to Section 2, beating the backtest trap. If our strategy actually survives that initial shock, it hits layer 3, where curve-fitted simulations go to die.
We use walk-forward validation, which forces the strategy through 3 chronological steps. Step 1. You optimize the parameters on a historical in-sample period. Step 2. You freeze those parameters, absolutely no peeking into the future allowed. And Step 3. You test it on the following unseen out-of-sample period. This repeats across the entire price history to prove it can perform without the massive advantage of hindsight.
To generate a realistic equity curve through this method, you have to hit a strict out-of-sample consistency of 60% or more across all those unseen windows. If it fails to hold that consistency, it just proves the strategy was memorizing the past instead of learning real market dynamics. And actually, if that happens, it's dead on arrival. Section 3. Surviving random market paths. Entering layer 4. Things get intensely mathematical.
A linear history just isn't enough. We have to stress test against randomness. Why does this matter? Well, because a strategy that only works in one exact historical timeline is basically a ticking time bomb. The market is never going to perfectly repeat its past sequences. So, using block bootstrap resampling, we generate thousands of alternative realities from the underlying data. A genuinely skilled strategy will perform across all these resampled scenarios, not just the one exact sequence it was built on.
Now, history is ruthlessly chopped up into multiple folds. With those gap or embargo periods sitting between the training and test sets, we create a strict quarantine. It guarantees absolutely zero information leakage. By evaluating every possible combination of these sets, we get a full distribution of out-of-sample performance paths, rather than just a single lucky pass or fail score.
Advancing to layer 5, the strategy undergoes a massive stress test. 10,000 Monte Carlo simulated paths. 10,000. We reorder actual trade sequences to build empirical distributions for the Sharpe ratio, max drawdown, and profit factor. Instead of trusting a single path, we build 90% confidence intervals on every single metric. If a strategy's performance wildly fluctuates across these alternate paths, it's flagged as highly unstable and tossed right out.
Section 4. Real-world regime testing. Surviving high-level math is one thing, but Phase 4 forces the strategy to survive reality.
There's a foundational philosophy at Apex. One bull run does not make a strategy. Let's face it, a strategy that only makes money when the entire market is trending up isn't robust. It's just a bull market passenger. You're not paying for an algorithm to just ride the elevator up. To root out those passengers, every candidate is sliced into 3 specific market regimes: bull, bear, and lateral, or sideways markets. If the algorithm fails to show consistent profitability, a positive expectancy in all of them, it gets flagged, demoted, or totally halted. It can't just concentrate its edge in the easy times. And we aren't just shuffling data randomly here. We use a regime-conditioned stress test. By using a Markov chain probability model, we simulate 1,000 synthetic market histories that preserve how real-world conditions actually transition, say from trending to choppy to highly volatile. It essentially creates realistic mathematical storms to map out a cone of plausible outcomes, which then directly feeds tomorrow's live drift monitoring. To actually protect capital in these wild, real-world regimes, Layer 6a steps in with strict, mathematically optimal position sizing rules. It uses a fractional or half-Kelly criterion, which is a formula for optimal bet sizing that accounts for estimation error while keeping risk low. Plus, there are automatic circuit breakers that will yank the cord and halt the strategy the second it shows any sign of regime failure.
Section 5. The Final Alpha Gate. Our strategy candidate is bruised, it is battered and thoroughly exhausted, but it has finally reached Gate 7.
You might think we're done, right? Well, a strategy can clear every single previous statistical hurdle and still just be a leveraged bet on the market going up. So this ultimate benchmark date compares this complex, elite algorithmic strategy against doing absolutely nothing, just simply buying and holding the underlying asset over that exact same period.
The final, non-negotiable requirement is that the excess return, the alpha, after subtracting market exposure, must be greater than 0. And a one-sided block bootstrap test has to confirm a p-value of less than 0.05. In plain English, that guarantees with 95% mathematical certainty that the edge is statistically real, not just a fluke. If it fails this, it's just noise dressed up as skill, and it fails the gauntlet completely, no matter how good the raw numbers looked.
So when you're looking at the Apex Executions platform and you see a strategy ranked and colored green on their leaderboard, this is exactly what it had to survive to earn that spot. No hand-picked results, 0 survivorship bias, out-of-sample validated across 6 intense statistical layers, and proven across every brutal market regime imaginable. As we wrap up this explainer, I want to leave you with this thought. Take a hard look at your own trading strategies, your own portfolio, the models you might be trusting your hard-earned capital to right now. Ask yourself honestly, could they survive this ultimate validation gauntlet? Because in the institutional world, hope and luck just aren't going to cut it. Thanks for hanging out with me today, and keep questioning the data.